Over the next several lessons, you will learn about various types of encumbrances that can affect real property. While the word encumbrance sounds complex, they are actually extremely common in real estate. Simply put, an encumbrance is a broad term that refers to anything that affects or places limits on fee simple, title, or the value of real property. Some examples of encumbrances include liens and easements. In this lesson, we will focus on different types of liens. A lien is a form of encumbrance that serves to create a security interest in specific, identifiable real property for payment of the property owner's debt or other financial obligation. At its most basic level, you can think of a lien as being a protection for a creditor. When there is a lien on real estate, it means that the lien holder has some claim to or right to part of the property's value. There are several different types of liens. Liens can be either general or specific, and either voluntary or involuntary. To understand the difference between the two, think of them this way. A general lien is a lien on the entire property owned by a debtor. In contrast, a specific lien is a lien that is only tied to a specific piece of a debtor's property. Now, let's explore voluntary property liens. As the name implies, a voluntary property lien is one that the property owner willingly agrees to accept, or that is the result of the property owner's voluntary action. The most common type of lien is a voluntary property lien known as a mortgage lien. When someone wants to borrow money from a bank or mortgage lender to finance the purchase of real estate, the mortgage lender has a lien against the property equal to the amount of the unpaid mortgage principal and interest. This is important for banks and mortgage lenders because they want to be able to protect themselves in the event the borrower, property owner, defaults on the loan. If that happens, the lender should be able to recoup the amount they are still owed for the loan. Mortgage liens are voluntary in the sense that the property owner agrees to the lien as a condition of being approved to borrow funds to purchase real estate. Of course, if a home buyer didn't want to agree to a mortgage lien, he or she could do that. But that also means they wouldn't be able to borrow the funds needed to purchase real estate. That is to say that mortgage lenders require liens in exchange for lending money. Mortgage liens are also specific liens, meaning that the lien is only attached to one specific piece of real property. This means that if the borrower defaults and the property is underwater, the lender cannot directly go after the borrower's other home or other non-real estate assets to make up the difference for what they're still owed, although they could pursue legal action in the court system. Let's dig into an example of mortgage liens, as it is highly likely you will encounter them on a regular basis when working as a real estate professional. Jimmy and Kim want to buy a vacation home, and they're going to take out a mortgage to finance 80% of the purchase price. As a condition of approving the loan, the lender will record or file a mortgage lien with the county where the property is located. Jimmy and Kim agreed to this when they signed documents at closing. The lender creates and files the lien against the vacation home. After 2 years, Jimmy and Kim decide to sell their vacation home. Unfortunately, the market has declined, so at closing, the amount they receive is only $1,000 more than what is still owed on their mortgage. The mortgage lien ensures that the lender will receive the full amount owed first. Jimmy and Kim will receive the $1,000 above the loan balance. Let's say that instead of selling their home, Jimmy and Kim fell on hard times and had to let their vacation home go to foreclosure. In this case, the mortgage lien functions as a security interest, helping to ensure that the bank will be able to recoup the sales proceeds up to the amount they are owed, and any associated foreclosure fees or expense as agreed to in the mortgage note. So far, we have looked at mortgage liens, which are voluntary liens. Let's turn now to involuntary liens. An involuntary lien is a lien against property that is filed or recorded and that does not require the consent or approval of the property owner. There are several types of involuntary liens, including equitable and statutory liens. An equitable lien is a lien imposed on real property by the court system. Equitable liens can occur when there is a civil or criminal judgment against a property owner. The court may enter and enforce an equitable lien against the property's value so that the person or organization on the receiving end of the judgment will be more likely to actually receive payment on the judgment. Equitable liens are also referred to as judgment liens. A judgment lien is simply a legal claim on all of the property of a judgment debtor, which enables the judgment creditor to have the property sold for payment of the amount of the judgment. An example might help put this in context. Let's look at Jill. Jill is a bookkeeper who was charged with embezzling $500,000 from her employer. After a criminal trial, Jill was found guilty and was convicted in court. The court awarded her former employer a significant judgment against Jill. Unfortunately, Jill doesn't have any liquid assets. So, the court created an equitable lien against Jill's assets, including her primary residence and her beach house, in order to enforce the judgment order. This type of lien is a general lien because it is not tied specifically to one asset or piece of real property. It's also an involuntary lien because Jill does not have to agree to it in order for the lien to be enforceable. A statutory lien is another type of involuntary lien. Statutory liens arise by statutes, laws. Instead of equitable liens, which require a lawsuit or court judgment, a statutory lien is created automatically by law. Some common types of statutory liens include tax liens, landlord's liens, artisan's liens, mechanic's liens, vendor's liens, and warehouseman's liens. Several of these are more common than others, so let's explore mechanic's liens and tax liens in more detail now. A mechanic's lien is a lien created by statute, by law, which exists against real property in favor of persons who have performed work or furnished materials for the improvement of the real property. That definition sounds more confusing than it actually is. A mechanic's lien gives a laborer, or someone who supplied material for construction or remodeling, a security interest in the property that benefited from the construction or remodeling project. So, if a property owner doesn't pay their contractor or building supplier within a specified time period and as agreed, the laborer or supplier can file a specific lien against the property to protect the amount they are owed. Almost anyone working on construction or supplying materials for the construction of real property can file a mechanic's lien, although the process of doing so can vary widely from state to state. Mechanic's liens can be filed by carpenters, laborers, plumbers, electricians, HVAC, or mechanical technicians, as well as by architects, civil engineers, lumberyard, electrical, and plumbing suppliers, and others. Other names for mechanic's liens include construction liens, laborers' liens, material men's liens, suppliers' liens, artisans' liens, and design professionals' liens. Mechanic's liens are involuntary because the property owner does not need to consent to the filing of a mechanic's lien. Here's an example of a mechanic's lien in practice. Bonnie is building a major addition onto her home. She hires and enters into a contract with a general contractor. When the work was finished, Bonnie refused to pay the contractor. The contractor filed a mechanic's lien so that if Bonnie tried to sell the home before paying him, he would be able to recoup what he's owed. Mechanic's liens can also be used to protect subcontractors. If, in our example, Bonnie did pay the general contractor, but the subcontractors were never paid, they could file mechanic's liens against the property. Now, let's turn to tax liens. Tax liens are statutory liens too, because they are imposed by law on property to help the IRS, states, or local taxing authorities secure the payment of taxes they are owed by the property owner. Tax liens are also involuntary because the homeowner or business owner does not need to provide consent for the liens to be filed or enforced. A tax lien is a way for the government to claim part of a property owner's real estate because of unpaid taxes. Generally, tax liens can be filed after the IRS or state taxing authority notifies the taxpayer of how much is owed, and the taxpayer doesn't pay the debt in full when it's due. Tax liens can be removed when the tax debt has been fully satisfied, although in certain circumstances, the IRS will consider discharging or withdrawing the lien even if the tax debt has not yet been paid in full. For an example of tax liens in practice, let's look at Ken and Amy's situation. Ken and Amy are both self-employed. Unfortunately, they underestimated the amount of estimated taxes they owed throughout the year. When it comes time to file their annual tax return, they found they owed an additional $15,000 in taxes to the IRS, plus an additional $5,000 to their state taxing authority. Unfortunately, they didn't have available funds to pay the taxes, although they received notification and a demand for payment from the government. In this case, both the IRS and the state may file tax liens against their property, so that if Ken and Amy sell their home, the government has some security that the taxes will be paid. In certain circumstances, the government can force a tax sale of property to recoup unpaid taxes from property owners. We have explored a variety of different liens. Before we close out this unit, let's talk about the priority of those liens. Priority is important because it establishes the order in which liens are given legal precedence or preference if there are multiple liens on a piece of real property. The highest priority liens get paid first, and any additional funds remaining, if any, are used to pay the remaining liens. This is why it is so important to have a lien in the highest position possible. Lower priority liens may never be paid if the funds from the sale of the property at foreclosure are not enough. Generally speaking, property liens have priority in the order in which they were filed, first in right. If the owner falls into foreclosure, the liens are paid off based on their priority. However, there are some exceptions to this rule. Tax liens generally take the highest priority no matter when they were filed. Mortgage liens will then take the next highest priority, as lenders want to be in the highest position possible in order to reduce their risk. Lenders may get to this position by requiring the borrower to close out all existing liens before issuing the loan. The remaining liens will take priority based on the date they were filed, with the oldest lien taking the highest priority.